everyone, to the Capitalmind Podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capitalmind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capitalmind Podcast. Today's episode is a bit shorter and covers arbitrage mutual funds, or ARB funds as we call them internally. Listen in to hear Deepak discuss what role arbitrage funds play or claim that they can play in your portfolio, how the recent changes in debt mutual fund taxation are likely to impact arbitrage funds too, and why Deepak thinks this is just a matter of time. We then talk through first and second order effects of tax changes on ARB funds and how this could, but we hope it won't, create a short-term buying opportunity if the changes are poorly rolled out. And then finally, we talk about what your risk-free or low-risk investment options are going forward in this likely new tax environment. So do listen in. Deepak, when we look at, say, options when it comes to asset allocation, there's the universe of equity, there's the universe of debt, there's, of course, good old stuff like real estate, gold, crypto, and then so on and so forth, although if I'm still allowed to say that's an asset. But there's today's podcast, in that sense, is about a category sort of somewhere in between equity and debt, if I could say that. So can you tell us a bit more, what do these arbitrage funds do, and what gap or role do they play or do they claim to play in your investment portfolio?
That's a great question, Shray. And in all political correctness, nowadays the new question is, what are your pronouns, right? So the arbitrage fund is something that looks like equity, but is actually debt. So, if you ask a fund what its pronouns are, it would say, hey, look, I look like equity, but I'm actually debt. So, but the point is, what an arbitrage fund does is that it buys stocks. The fund manager will buy a stock and sell a future at exactly the same time. So the idea being that if the stock goes up, the future also goes up. So what you've bought has made money, but what you've sold has lost money. And therefore, you don't gain from the price difference. But the same way, if the stock loses money, the future falls, and because you've sold the future, you make money, and on the stock you don't. So you essentially make the difference between the price of the stock and the price of the future the minute you took the trade, and therefore have no other price risk beyond that. This is essentially the difference. Now, what is a future? A future is simply you're buying a stock not today, but on a certain settlement date. That settlement date is maybe, say 1 month into the future. In the future, that's why it's called a future in this first place. So the idea is that if I can buy the stock today itself and sell it as a future, sell the future contract 1 month down the line, I make the difference in the prices for a month. That difference in prices should, because there is no now risk of the price moving up or down, should reflect the risk-free interest rate in the market. But sometimes it gives you a better return than that. Now, here is where there is actually a very, very big difference in how the perception is of an arbitrage fund versus something else. Now, why would you buy an arbitrage? You might say, Deepak, listen, why am I doing all this complicated stuff? Why don't I just go buy a fixed deposit or a liquid fund instead? The answer comes in the income tax code. The income tax code says, if you have a mutual fund that has 65% of its investments in equity, it is an equity fund. I'm like, okay, great. So what's the big deal about equity funds? Well, answer is short-term capital gains taxes. That means if you sell the fund within a year, you pay only 15% of the returns as tax. And beyond a year, you pay only 10%. Now consider that the income tax rules on debt funds are far more laborious. You are only allowed to pay short-term capital gains, and short-term capital gains taxes are basically the gains are added to your income. So if you're making more than 10 lakh or 15 lakh rupees per year, you're taxed at 30% plus. So essentially, there's a massive tax advantage in a product that's giving you close to risk-free returns, but with less than half the taxation. So this is where the difference has been not great in terms of the amount of returns that you could get between a liquid fund and and an arbitrage fund. But the main thing here is, since over a period of time, if you're able to pay a lot lesser tax on such amount of money, you could actually put money into arbitrage funds. The interesting thing is that while this has reflected the risk-free rate, the risk-free rates themselves have changed quite considerably. Right? About 5 years ago, they were 8% or 9%. About 2 years ago, they were 4% or 5%. Now it's come back to 7%. So the arbitrage fund returns have also mimicked the change in risk-free rate. So in a way, they do behave like liquid funds or short-term funds, but the post-tax returns are better than even long-term debt funds, or much better. So to give you an example, I think in the last few months, they have made an annualized return of more than 7.1, 7.5%. If you take taxes of 10% out, so I'm assuming I've held this fund for a year, I'm getting a post-tax return of 6.8. You know the kind of return you need to make in a debt fund today, if it's added to your income at 30%, you need to make something of the order of 10% pre-tax in order to be able to get 6.8% post-tax. So obviously the advantage to this is, like, I look at an arbitrage fund yielding 7.5, and in my mind I'm thinking this is equivalent to a 10% liquid fund, because I can get money out whenever I want and I have a very small taxation to pay. The last month itself, we've had about 7.1% returns, even though yields have come down in the market. So you've seen that risk-free yields and short-term yields were going as much as 7.7 to 7.1%. And then they've now come back to 6.6, 6.7. Yet an arbitrage fund has given in the same month roughly 7.1. The highest of the category, I think, is about 8.5 or 8.3%, and the lowest is about 5.5. So the category by itself has done really, really well. There's nothing else that gives you something like this post-tax, and therefore you would expect that more money would flow into arbitrage funds, given the fact that now the taxation is regressive on pretty much every alternative opportunity, like funds with guaranteed returns, like endowment funds in insurance policies. You've got debt funds which are taxed badly if they have more than 35% equity, less than 35% equity, which is pretty much all debt funds. And I think fixed deposits are always taxed onerously anyways. So you end up with this being your bastion of hope in terms of post-tax returns.
I'll start before that, though. Given what you've just said, weren't these arbitrage funds in a sense a bit like can I use the word superior fixed deposit? Because unlike, say, a debt mutual fund, where even if I could hold it for long and potentially make, 8, 9%, the fact is that when the interest rate cycle changes, there's a mark-to-market loss. So you could wake up one morning and find your debt funds down, say, 10%, which is not a very happy feeling. That wouldn't have happened in these arbitrage funds because of what you've said, or would happen to a much smaller extent. So why didn't this category go on to become like a huge FD replacement category per se?
Yeah, I think this is actually a very interesting point, because the long-term returns on these funds, even sometimes pre-tax, without the tax implication itself, was slightly better than liquid funds, and tax is unfavorable to the liquid fund, right? So you expect that the post-tax returns are ridiculously better. To the AMCs, this was even better. In the liquid fund, they typically charge 0.2%, 20 basis points as fees. Here, literally, there is zero arbitrage funds charging less than 20 basis points. Almost everybody charges around the 30, 35 basis point number. And there's a fund that charges even 0.96, nearly 1%. It's a really small fund. The largest arbitrage fund is currently Kotak Arbitrage. This charges 43 basis points at 20-odd thousand crores. It used to have 35,000 crores in it. At 43 basis points on 20,000 crores, that's 100 crores or 86 crores really on earnings on just the arbitrage fund to the AMC alone. This is fantastic, right? So you would imagine that the AMC would be very, very in love with this product. After these fees, this is a fairly large fee, but even after these fees, in 6 months, the return of this fund, which is among the higher AUM, highest AUMs, and also has one of the highest fees, 0.43%. They have had a 6-month return of 3.63%. 6-month return of 3.63% translates to 7.26 in a year. That's 7.26%. 7.26% there was no FD that was giving you this kind of return. So it's favorable for the investor.
6 months ago. Yeah.
6 months ago. So, I mean, now, of course, there is. So, but you have the other disadvantages of an FD. You have a minimum term. You have to know, I want to lock my money for a year. If I lock it for less than a year, I won't get the return, and so on. So here, in an arbitrage fund, you don't have that minimum term. You don't have breaking charge. You often don't get good returns if you don't have a plan to keep money for at least a year. So below a year, they're like, oh, listen, 1 year will give you 7.1, but 6 months will give you 5.5. So you're like, dude, come on, don't do that. But in an arbitrage fund, it's more smooth in the sense if you're getting 7.26 in a year, you're probably getting 3.6 in half a year, and so on. It's not exactly that. But now, none of these funds have pushed the product. SEBI itself, for instance, may not want you to say this is an alternative FD because they're like, dude, FDs are RBI's problem. You got to be at least visibly taking some risk here. There is some interest rate risk. But here's the best part. In a long-term bond fund, you lose money if bond funds, if the interest rate goes up. Your yields go up and your prices go down. You don't tend to lose money in an arbitrage fund. You're just that the returns will go up or down in terms of I will make 7% versus I will make 5%. But I don't make minus 5% mostly. It may be in an interim day in the month. But typically in any month, because you're holding to expiry, you're never going to take a negative arbitrage. You're always going to have take only a positive arbitrage, which means I will always sell something for below the price that I sell it at the future level. So this has a structural advantage as well compared to a regular debt fund. But yet, funds haven't pushed it. But I think there's a bigger problem. That the problem is if funds believe that if they push this product would become so big, it will make the market really unstable.
You were talking about that before we started. So can you tell me, how big are arbitrage funds and what does that mean as a percentage of the total volumes or positions on the stock market?
This is actually the key question here because the second part. Now, let's look at the total market today. Of all the arbitrage funds, if you add all the AUMs together, we're talking about 82,500 crores in arbitrage funds. And this is around April 25th, 2023. So there is around 90,000 crores or whereabouts that has been the average for the whole month. 65% of this. Now, the way the arbitrage fund works is if you give it 100 rupees, it's going to take 65 and buy stocks. It's going to use the remaining 35 as margin plus the mark-to-market difference to balance out the remaining 35. Now, the way it works is this. Let's say I buy Reliance for 65 rupees, just to give you a small example. And I sell the Reliance future for 65 rupees. I can take the 65 rupees of Reliance that I have bought and use it as margin. But for the margin required for Reliance, I am going to have to put half of that money in cash. So the amount of money you need in cash is probably another 5 or 10 rupees. So they keep that 5 or 10 rupees in cash, that is in short-term liquid instruments, and the remaining they might take some debt instrument and so on. So assuming 65% of this 90,000 crores is in cash. Now we're talking about nearly 60,000 crore rupees is only in arbitrage funds sitting in both stocks, long, and futures, short. So they are responsible for around 60,000 crores of the open interest in the market. This is about 1 day before expiry. So right now the positions may be a little wonky. But right now there's about 200,000 crores in open interest in the futures market. And I'm talking about stock futures, not index futures. Index futures doesn't matter because none of the arbitrage funds tend to do index future arbitrage. They buy a stock, sell the stock future. So India is the single largest stock futures market in the world. So we are one of the largest players in this space. The arbitrage funds are 60,000 crores. the volumes of total open interest in the market is about 180,000 crores. Now, that is right now split between 115,000 crores for the May future, and April future, which is maturing tomorrow, has about 80,000 crores in it. So there's a little bit of a short-term play here. A lot of traders do short-term 1-day, 2-day trades very close to expiry, and assume about 10 or 15% is that. So roughly 150 to 180,000 crores is the total open interest in the market of all futures put together, out of which today we're saying 60,000 crores is just the arbitrage funds. Effectively, arbitrage funds are between 30% and 50% of the entire market, because we've seen the arbitrage fund AUMs grow even more than the current 90,000 crores. Now, here's the other part. There's another category called balanced advantage funds. Balanced advantage funds typically have 35% in stocks, 30 to 35% in equity arbitrage. That means they would have done the arbitrage between equity and future, stocks and futures, and the remaining 35% in debt. Now, why do they do this? Because they say, listen, we want to give you a 30% or 35% equity product, but since there is no tax advantage to giving you a 30 to 35%, there hasn't been. The minimum is 65%. You need to have 65% for the income tax department to love you. So let's do the remaining 30-35% by putting equity arbitrage positions, and the remaining as debt. Fantastic. Except this category has more than 100,000, more than 1 lakh crore in AUM. If you take 35% of that as an arbitrage, that's about 35,000 crores. Add it to the 60,000 crores that's sitting in pure arbitrage funds. You're sitting in at looking at these two categories of mutual funds, roughly owning more than half of the entire futures open interest marketplace, which is amazing, but it's also going to create a problem.
So what is the problem? We get it. This is large. It's large both in absolute numbers and as a percentage of overall volume. So what's the problem? When will it happen?
So, till now we were all fine because, it's there, it's large, so what? The answer comes in a statement that the finance ministry has been saying. We don't want debt funds. We don't want to reward people who don't want to take risk. So we don't want to give debt funds a tax advantage, which is why they took away the tax advantage of the insurance policies above 5 lakhs, of market-linked debentures, of debt mutual funds, because all of these products were giving people a tax advantage only when you had, even when you were taking no risk at all, not much risk, at least meaningfully. So the income tax department said, listen, if an FD is equivalent to taking no risk, so is a debt fund, so is a market-linked debenture. At some point, they come into the conclusion that, listen, we are going to look at arbitrage funds because they're not taking any risk. If they're not taking risk, why are we giving them any market advantage? They can change this very, very simply. The way they've reworded right now is they say that a fund is classified as equity if it has an investment of 65% in equity instruments listed in India. If they change the word investment to say net investment, net of any futures short positions, that is pretty much the death knell for the tax advantage for both arbitrage funds and balanced advantage funds. And there will be a fear. Now, also look at the timing. It may be complicated from a timing perspective, but I think this is also important because the way I'm seeing it, it's probably a coincidence on time, but in 2024, in February, there's going to be a minor budget. The minor budget is called an interim budget. They don't do anything major in a minor budget, in an interim budget, because the government could change in May when the elections happen. So they typically, as a sign of respect to the next finance minister, they will say, listen, we won't do anything major. And the actual budget in the election year is in July. In July, the financial year has already started. So if you create a new rule, there's no way to undo what you've already done in the last 3 months, right? So the rule becomes applicable instantly versus in a February budget, you get till March 31st to figure out what to do. And then from April 1st, the budget applies. So the difference in the timing may happen now. But what will happen if it comes in July is the minute, if the finance minister says something like this, the minute they say it, everybody will get spooked and say, oh my God, my ARB funds are now going to be taxed as debt, can I just sell? They will look at it and dump the things. Guess what happens then? You have a massive issue in terms of suddenly people saying, listen, let me redeem my funds. Funds, when they get the redemption, they have to pay it out in 3 days. That means they have to sell today to be able to receive the proceeds and then sell it. So if the budget happens at 2 o'clock, if they get redemption request before 3, they're going to have to dump those. So what do they own shares and they have sold futures. They have to buy back the future and they have to sell the stock. And all of them will have to do it roughly the same time because they would have got. So what happens to a market where your average trades are 50, 60,000 crores a day, and then one category of fund is trying to sell 60,000 crores of stocks per day, another category is trying to sell another 30,000 crores of stock, and all of them are trying to buy futures which are equivalent to half the open interest in the exchange. The spread between the stock and the futures will widen. It will cause a massive disruption if such a rule comes, especially mid-year. And even at the end of the year, you're going to cause a disruption, but not so much. I think here is where action needs to be taken, or a thought process needs to be put in place, saying if this does happen, I'm not saying it's illegal, because as in that we should protest that this should not happen. I'm saying that this is how it's going to happen because it's debt, it looks like debt, it quacks like a duck, it's a duck. So if it comes, we have to mitigate whatever happens when it comes. It's like, booking yourself a COVID room in advance in a hospital, thinking that if I get it, and maybe you're in a situation where you will get it. I mean, I think we have to create a situation where, such a change is not disruptive, because it is now obvious that this is going to happen. Whether it's next year or next year, we don't know, but we know that this is going to happen.
So I get it. I'm just trying to think through the can I call it first order, second order, and so on type of effects. There's clearly this is happening, we should just sell. This asset class doesn't make sense anymore to me. So let's just get rid of it. And which could, as you say, cause some very short-term problems. And I hope there's some solutions there, which maybe you can talk about. But what happens beyond that? I mean, there's obviously a short-term problem, but there's clearly then a medium-term problem as well as to what is the future of this asset class, if I can call it that, and what else will happen, because these were very large numbers. So isn't this going to have an impact on the market per se in general?
Yes, firstly, let's look at the first order effect. First order effect is things come in, you're an ARB fund manager. You've been told, like, listen, I've got so many redemptions, let's get out. You want to call the broker and say, or call your dealer and say, listen, dump all the stocks and buy back all the futures instantly. We can't afford to wait because we have to give people back their money. They do it at whatever price the market tanks and goes to. They has to be a mitigation to this. The first order effect mitigation has to be of the order of SEBI saying, can we please, because we've preempted that this might happen, can we allow funds to wait till expiry? Now, there's a very interesting reason why. India, all stock futures are now what are called settled by delivery, which means if you buy a future, you may pay only 10% of it as margin today. That means if you buy 5 lakh rupees worth of, say, a Reliance future, you can pay only 50,000 rupees today. But if you allow it to expire, reach the maturity date, which is the end of the month, in this case, tomorrow is April 27th, that's when the expiry is going to be. So on April 27th, I pay the remaining 4.5 lakh rupees and I get, X number of Reliance shares in return. That's how settlement expiry works. If I sell a future, I am required to have already had those shares in my bank account, and then I will deliver those shares to the broker saying, against my sold futures contract, please deliver the following shares. All perfectly fine. If you redeem today, I have to buy back the future, I have to sell the stock. I mean, it's a pain. Instead, if since I already own the stock, and I have a short future, I can hold it all the way to expiry and say, whatever stocks I have, please take them. I'm not going to sell them in the market, but whoever's bought the future will obviously get a hold of these shares. This is a less intrusive way it's less destructive in a lot of ways to the market itself. This changes perspective, and SEBI should allow this in case this does happen. And maybe they should even make a representation to the finance ministry saying, let this rule kick in, but only after the expiry, which would, effectively ease a lot of the settlement dynamics instead of everybody rushing to sell right now. They should probably do this for balanced advantage funds as well. But balanced advantage funds, they're named that. They don't necessarily have to have arbitrage positions in them. So they might have a different impact compared to all of this. But I think this does make sense. It does make sense to kind of reduce the impact, the first order impact, by telling people, listen, you've redeemed. You will get your money, but you will get it at the end of the month. You will not get it immediately. This is a playbook SEBI doesn't like, saying you made a contract saying that you will give the liquidity whenever the customer wants. Now you're telling them to wait till the end of the month. What is this? But I think it's just fair when you have a 50,000-60,000 crore impact on a market that you create some kind of it's like, why does a trapeze artist need a net? Because if they're so experienced, they don't. But you need nets. You need safety nets at some point. So I think this is a good safety net to have, contingent on a rule change. And by the way, this rule change can come anytime. We know that. So we should be ready for it in advance itself. The second order is more complicated. Like, what happens after? The expiry is done. People have...
And let's say that this sounds like a very, what can I call it, modest intervention. Obviously, you have to bend some rules or change some rules. But I think everyone would operate in the interest of, let's not have the markets tank 10% just because of a 1 month problem. And have some sophisticated investor on the sidelines making a quick buck of everyone else. So
yes, unnecessarily, if stock prices were to fall like crazy, it is the deep-pocketed, the more rich who would be able to take advantage of that situation. And almost like mutual funds would be like, dude, you know what? I was forced to sell. We should probably do another podcast on forced selling, and maybe that will... forced selling is exactly this. It's like, I don't hate the stock, but I'm going to have to sell it because of some technical rule. So coming to the second order effects. Now, if you're looking at the stock futures market, I said it's 180,000 crores and 95,000 crores is contained by these two categories of arbitrage kind of funds. This second order effect is that the market collapses to half its original value. And the reason why the stock futures are priced at a certain distance from the stock price itself is largely because the spread should be equal or close to the risk-free rate. Now, if people aren't investing in arbitrage funds because the risk-free rate is... people will rush out of funds simply because arbitrage funds have one peculiar problem. And in an FD, you know exactly how much you're going to get. In a debt fund, they'll tell you the yield to maturity, so you can roughly guess what you're going to get. In an arbitrage fund, there's no guessing. You just have to wait till you get it. That's how it works. And if you trust the market enough, of course, there. But people don't like not knowing how much they get, right? So given that, arbitrage funds will become less attractive than regular debt funds or FDs or some other kind of product. So you end up with people trying to sell regardless. But because now arbitrage funds become a really small asset class in comparison to what used to be earlier, the futures market collapses into a much smaller type of market, compared to everything else. This actually has a peculiar issue because a lot of people buy futures. This is retail, HNI, everybody. I'll tell you why. Let's say I want to buy Reliance for 5 lakh rupees. I don't have 5 lakh rupees. I have only 50,000, but I want to take a leveraged bet of it, 10x. These are players who will take the leverage bet of 10x simply so that they can play on Reliance in a shorter time. And it's largely retail and HNIs who buy futures. Even foreign institutional investors who have a tax advantage in buying futures, because if you and I buy futures, we get taxed in India as business income. We have to actually create a business turnover and a balance sheet and all that, even at a personal level, to be able to file taxes. Your taxation is always obviously higher. It's if you're in the 30% bracket, you pay tax on that separately and so on. And FII can classify all their futures and options trades as capital investments, as hedges if they want. And therefore, they pay no higher tax on investments such as futures and options. Because for them, the taxation is more efficient, you end up with that as another complex problem that sits, that they're also buyers. Now, what happens to buyers is, now when the sellers were available as arbitrage funds, remember, they were half the open interest. If you have the same demand but less supply, prices go up. The futures price will therefore go higher than the stock price. it also changes the view on the stock price itself. There isn't as much demand for stocks because 40,000-50,000 crores of demand has gone away from stocks, but that's a one-time stock measure. So stock demand may continue as it is, but futures demand will weaken because futures have to be, bought and sold every month. So they mature, the next month future has to be bought and so on. So, or sold. So given this, I think there'll be a pretty big impact on the values on the funds itself. Now, or rather on the market itself, where the futures market becomes wider. Here's the other impact of it on the AMC side. You're looking at balanced advantage funds, you're looking at cash. We're talking 2 lakh crores roughly. And in the 2 lakh crores, all of it was charged at a much higher AUM fee compared to the AUM fee that you would apply for a liquid fund or a short-term debt fund. So you'd instead of paying 20, 25 basis points, you're paying 35, 40, 45 basis points for most of these funds. Now, that fee reduces because the AUM goes away. So the AMC industry is going to see a contraction in revenues, especially in the large funds who have large classes in balanced advantage, in arbitrage, and so on. The balanced advantage fund, which has a 30 to 35% arbitrage position, does have a small continuously advantage, but you end up with a situation where you cannot make up take 35% equity to 65% equity without affecting the mind of the unit holder, because the unit holder is saying, listen, I am okay with 30-35%. There's a little bit of volatility up and down. That's fine. But if the market tax 40%, I don't want to lose more of my investment. That's why I invested with you. So should I even bother investing if you go to 65% equity? Or if you retain it at 35% equity, then I will be taxed on my investments as if it were debt, which is not what I signed up for in the first place. I signed up because I wanted to be. There are some balanced advantage funds who are taxed as debt as it is, but I think the largest funds try to make themselves into equity by keeping to the 65%. This thing. So you got all of these impacts. That's the second order, which AUM will be lost by the AMC industry. People will move away from arbitrage type of funds and move to actual either debt funds or debt products like FDs and MLD, or not MLDs, but non-convertible debentures or something of that order. And you're going to see much lower volume in the futures market. So you're going to, it's going to be crunched into a much smaller thing. So volatility in the market itself will increase. By the way, I think one of the biggest reasons why stocks have been traveling in a narrow range is largely because of the players in both the futures and the cash market. The more such players exist, the less volatile the underlying, and we've seen this in the index itself. The index and the index stocks are naturally less volatile because you've got a futures player who's willing to arbitrage between the futures and the stock at some point if the spread is too wild. If you don't have enough players, volatility increases. So I think it's going to increase market volatility in the second order. Now, apart from the fact that the cash market doesn't have volumes, you actually have a situation where you're going to see the market less sufficient, but since the retail investors and HNI, and this is maybe a third or fourth order effect, if the spreads widen, so what you're getting as 7.1 today becomes 9.1. Now 9.1 is suddenly more attractive to the corporate who didn't ever care about the tax in the first place. He was like, give me the highest yield possible. But if he sees a 9% yield on arbitrage, you might be like, listen, I'll take that risk. It sounds like 9% is a good spread to take. So you're introducing new players into an arbitrage market, which was earlier dominated by retail and HNI. So this might be a third or fourth order effect of this. Maybe not so much to institutions because institutions don't pay tax anyway, but to corporates it might become more attractive simply because the yields become more interesting.
If a Capitalmind customer had money in arbitrage funds and was like, now what do I do? What would you tell them?
I think this is, I think what I should do is go down the route of saying there are 3 or 4 pieces of advice that I think the ecosystem needs.
Sure.
Let me start with it backwards.
Okay.
So let me start with the finance ministry. So the finance ministry goes into, I want these people to be taxed as debt. I completely understand this is exactly what you're here for, to decide whether something should be taxed as something or not. And you decided to give equity a lower taxation rate because it allow people to take risks. And here people are not taking risks. So I understand your philosophy, but you should also understand that the market will get impacted. Therefore, could you allow this rule to happen, start from the day of an expiry? Or if you're doing it don't do it in July, do it in a February, so it gives people time to, because in a February budget, you get till March. In July, you don't get anything. So either of the two that should be done, that allows a transition to be more smooth. Now, I think finance ministry will not listen to like Capitalmind or anything like that. I think the best person to do this representation should be SEBI. It goes to the finance ministry and we know you want to do this, but can you please tell us before you do this so that we can plan it out? And maybe we can sit together and decide the date. I don't want to decide. I mean, obviously I can't override the finance ministry, but we can just give you the input that please do it on a certain date. The last part, which is being, I think, the SEBI can do is allow mutual funds in case the finance ministry doesn't listen, which is quite likely because, they have to listen to so many people, they may not listen to everybody. But if they don't understand this part, that SEBI knows that there's a market disruption possible and they should in advance prepare themselves to release some kind of a circular that says, listen guys, since this rule has now come, I will allow you to defer any payouts till the date of expiry of the immediate expiry coming in soon, so that you don't go and disrupt the market all at one shot. You can wait till that time and then pay out. That also makes an important point. Of course, there are small things like, which NAV will you get? But I think you should get the NAV of the date that the expiry actually happens. So, you can do this. Now, if you're an individual who are invested, there are two things. First, many of you have invested because of the tax advantage and that's gone. So you might say, dude, this is no longer interesting because it's tax. Without the tax advantage, I want the surety of a return, and I can get the surety of a return in FD. I can get some kind of surety in a debt fund because they give me the yield to maturity. I can calculate approximately how much I might make and so on. So roughly, by and large, I can figure out how much I'll make. In an arbitrage fund, I can't. So it's unfixed income. It's not fixed income. So because, it's income, but it's not exactly fixed and you're depending on the vagaries of the market. So, and it's not the vagaries of the market on the negative side. It's a vagary of the market on the positive side. So I might make 7%, I might make 6.8, I might make 7.4. So because of that, I would rather not be in such a product. Yes, fine. Then get your money out and move into where you think you're more, you're in a better place. The second set of players would be people who said, listen, I want a great post-tax return and I'm not going to get it anymore. My answer to that is, hang on. If the spread widens to 9%, isn't it a better post-tax return than something that is similarly taxed, but you get a 7.5% return? So now you're going to compare likes to likes, except the part here, which was 7.1, has moved up to 9.1. Isn't that more attractive? So maybe it is useful for you to stay a while, see if these spreads widen, and then maybe post-tax returns are still good or good enough. Your problem, of course, is that the mutual fund, when they lose all that income, they're going to increase their expense ratios and probably take away the excess return that they make. But, that might actually be, an issue. But having said that, I think still here, this is a wait and watch game rather than, jump in kind of a game, jump in or jump out, So I'd say if a person who's looking for returns, but assume that they're going to get a lower post-tax return now, may not necessarily need to sell. Only the people who came in for a tax advantage do. The last bit, I think, is the AMCs. AMCs, which are the mutual fund managers and so on, they're going to lose 200,000 crores, or they're going to see potential losses of 200,000 crores in AUMs where they go away. So you want to give these people an alternative to move to in case such a thing happens. You want to soothe their fears when such a thing comes to light. So you want to prepare documentation, collateral in advance, you've got to figure out what to do and so on. And of course, you've got to have a strategy to get out, because you've never gotten out of all these products at one time. You've never gotten out 30,000 crores from any of these funds, even as an industry at any given one time. A lot of AMCs have been using arbitrage funds also as interesting selling grounds. Because if I want to sell, I don't know, a Bharti Airtel, I would possibly say, listen, I have 5,000 crores, I have 1,000 crores of Bharti Airtel to sell. How do I sell it? You know what? The market's not going to be able to absorb it all in one day. So instead, let me do this. Is there an arbitrage opportunity in Bharti Airtel? Well, there is. Why doesn't my arbitrage fund take that arbitrage opportunity? I will sell the Bharti Airtel that I have, and the arbitrage fund will buy it from the market. That allows Bharti Airtel to be sold over a period of time. And then, of course, the arbitrage, when it matures, it will automatically unwind itself, or they will continue to arbitrage it as time comes. So I'm not saying that they do use it, right? It's a possible use, and we've seen this in many places. We've also seen in a certain arbitrage fund, you've seen spikes of returns. Some spikes of returns can come because certain funds, certain large index funds, for instance, they've got a bunch of stocks in them. Those stocks sometimes gives rights issues. Rights issues come with something called a rights entitlement. It's listed on a certain date, and when those rights entitlement shares are listed, they trade for a week. Whoever ends up owning the rights entitlement is now required to pay a certain amount of money and takes the rights shares. The rights shares are again traded in the market, and they are traded as long as the rights are not called by the company. Very complex procedure. But if you're an index fund, you are getting these rights entitlements for free, and they're going to be listed in the market, but your index doesn't have them. So you have to sell them. The index providers put a certain value based on some complex formula and say, well, these should be worth 150 rupees. And because of the optionality implicit in rights issues, and maybe we should do another thing around that, we have the optionality inside the rights issues creates a market value that is higher. So if by theoretically my rights issue should have traded at 200 rupees, practically when it does trades at 300. An index fund, since it doesn't have to own this product, can sell it at 200 rupees to the arbitrage fund, who then takes a short future position to balance it out. And when it lists at 300. So the arbitrage fund sees a valuation jump, which was done in a few cases last year or 2 years ago. Very rare, but again, arbitrage funds were used as, so it's like it attracts more money into an arbitrage fund when it shows great performance, right? So you end up with more AUM flowing to that fund. All of these tricks will go away. So you no longer have the same security as an AMC, that you have an arbitrage fund that can absorb the volume of a mid cap, which you own too much of, and therefore you need to sell, which has a futures component to it. So I think AMCs need to be even more careful in terms of how they do this. I'm not saying what they're doing is illegal, because almost all of these things are legally allowed in whatever part of the context they have. But in general, these are things that are not going to be available to them at a later point. Apart from the fact that they're losing 200,000 crores of AUM that's at risk because of this. So I think they need to think about it a little more. For the individual, I'd say don't overreact and don't jump out of things just because a rule has come. But at some point, hopefully, it may pay to have deep pockets. If nobody follows anything we've heard so far in the market does tank because of forced selling of arbitrage funds, I would say, and no finance minister wants to be known as having triggered a 10% fall in X stock or 20% fall in
for a month.
For a month. So it just sounds like this is the worst kind of feedback they want from a budget. So hopefully they will listen. But if they don't, your opportunity lies in simply being able to take money and invest it in what is a stupidly sold market. It's not being sold for fundamentals. It's been sold for, somebody's going to pay higher tax, therefore somebody's selling.
Well, Deepak, I think this is one of those episodes where it'll probably be silent for a long time. But if and when this change happens, we'll pull it out again, and hopefully we'll see how it compares.
This is a we told you so.
We told you so, or otherwise it'll be forgotten. Well, thank you so much, and let's see when this arbitrage ends.
Yeah, that's a good one. Good one, Shray. Cheers. Thanks.
Thanks everyone for listening. If you have feedback, ideas for new topics, or questions, just send them over to podcast@capitalmind.in. And if you have more than, say, 50 lakhs and are looking for someone to help manage your money for you, then why don't you have a look at what we can offer at capitalmindwealth.com, which is the website for our portfolio management service, or PMS. And if you just want to read more about how we think and analyze all things finance, visit capitalmind.in.